Welcome to the final lesson of Introduction to Financial Accounting, and in this lesson we are going to discuss accounting principles, which are also called accounting concept. We discuss the possible indication of going concern problem, and then we discuss qualities of useful accounting information. So you can kindly subscribe, and if you subscribe, I'm giving free summarized financial accounting notes and answers to customary past paper question from 2015 to 2023. Therefore, let us now start with accounting principles. What are accounting principles? Accounting principles or accounting concept are, are the rules and guidelines that companies and other bodies must follow when reporting financial data. If a company is preparing financial statement, there is a set of rules that that company must follow. There's a set of rules that that business must follow. There's a set of rules and guidelines that every organization preparing financial statement must follow. Those rules and guidelines are what we are calling accounting principles or the accounting concept. So let us proceed and see which are these accounting principles we are talking about. And the first accounting principle is the principle of relevance. Is the principle of relevance. And we say that financial information is relevant if it can help users to make decisions. Remember, financial information or financial statement, they are prepared for users. They are prepared for users to make decisions. And users of financial information, they include investors, readers, government. Therefore, financial information must be relevant to help them in making decisions. And for financial information to be relevant, that information must be prepared on time, that information must be accurate, and that information must be understandable. If an investor wants to invest in a company, he will require current information. He will require information which has already been prepared so that it can help him. He will require that information to be accurate. Inaccurate information is irrelevant, and he will require to understand that information to help him or her to make informed financial decisions, such as whether to invest in your company or not to invest. The second accounting principle is the principle of reliability. It is the principle of reliability, and it requires accountant to record only that accounting information which can be verified with objective evidence. This principle of reliability require accountant to record information which can be verified with objective evidence. And objective evidence here, it include sales receipt. For example, if in the company we are saying that a sale has occurred, then we must produce a receipt to show that a sale has occurred. That is an objective evidence. If the company has purchased some good, we must produce purchases received to show that actually the company has purchased good. Purchases received are objective evidence. If we have received some cash in the bank or we have received some check, then the bank statement should be able to support to support that actually cash has been credited to our bank account or cash has been debited to from our bank account in case of payment. So that is what we are calling objective evidence. Then we go to the third principle, which is the principle of neutrality. And neutrality principle means that financial information should not be biased, either deliberate bias, where management intentionally misstates financial statement, or systematic bias, where accounting system has inherent tendencies of favoring one outcome than the other. Neutrality simply means that financial information is not pessimistic or optimistic. It is there in between, and it is not influenced by either the management or the accounting system to support a certain outcome. So that is all about the neutrality principle. Then we go to the fourth principle, which is the principle of faithful representation. And faithful representation, it means depicting financial information, depicting financial information which is complete, neutral, and free from error. You depict financial information, that is, financial information must be complete. Complete means that it have all the quality, it have recorded uh, all the information of a certain the of the economic phenomenon that we are talking about. If we are talking about trade receivables, all the trade receivables have been recorded. Nothing has been omitted. If you are talking about trade payables, all of them has been recorded. And then that information is neutral. That information is neutral. So that information neutral means that it is not either pessimistic or optimistic, and it is not biased. And then that information is free from error. That information is free from error. Then we go to the fifth principle, which is the principle of prudence. And we say that in accounting, prudence refers to the concept of being cautious and conservative when making judgments and estimates. This means that accountants should not overestimate revenues or underestimate expenses, but instead they should err on the side of caution and make conservative judgment. Therefore, this means that as an accountant, you are not when you are making estimate, you must be cautious. You must be conservative in such a way that you don't put the business at the risk of loss when you overestimate revenues, and you underestimate expenses. If you do that, you can put the business at a risk, because if you do not achieve your overestimated revenues, and if the expense you had estimated expenses, and you incur more expenses than you had estimated, then that is a problem for your company or for the business. We go to the next principle, which is the principle of completeness. And this principle simply means that financial information should present a full view of the affairs of an entity. Then the other principle is the principle of measurable stroke money measurement concept. And this principle states that only transactions and events that are capable of being measured in monetary terms are recognized in the financial statement. However, transactions that do not meet this criteria are disclosed in supplementary note. In financial statement, you only record and put those transactions, those events in the business which can be assigned a monetary value, which can be able to be measured in monetary terms. For example, in an organization, you can find that in a certain day, employees are motivated. Motivation cannot be measured in monetary terms. Therefore, that is something that you cannot put in the financial statement. But that motivation can lead to a lot of production in that day. It can lead to the high production in that day. The production itself, since the goods produced can be measured in monetary term, that one can be put in the records in the financial records of that company. We go to the next principle, which is the principle of recognition criteria. And this principle is simple because it requires that the element of financial statement, and we said that element of financial statement are assets, liabilities, income, and expenses, to be recognized only if they can be assigned a reliable value. You can be able to measure the exact amount. If it is an asset, for example, a motor vehicle, you can say that the cost of this motor vehicle is 3 million. If it is an expense, for example, rent expense, you can be able to say that the rent expense for this year was 200,000. You can assign a reliable value. But if you cannot assign a reliable value, then you are not supposed to recognize that expense. The other principle is the principle of matching principle, the matching principle concept. And it requires that expenses incurred by an entity must be charged to the income statement in the period in which the revenue to which those expenses relate is earned. Expenses incurred by an entity must be charged to the income statement in the period in which the revenue to which those expenses relate is earned. For example, if you earn if you make sales in this period, then the cost of those sales must be accounted for in this period. Even if you pay for the cost of those sales in the next period, you must account for those costs in this year. For example, one example of cost of sale is purchases. Let's say you purchased your goods on credit, but you have earned your revenue in this period. Then those purchases you pay you pay your creditors next year. You're not supposed to recognize those purchases in the next year. You're supposed to recognize them in the current year. That is all about the principle of the matching principle or the matching principle concept. Then we go to the 10th principle, which is the principle of single economic entity concept. And this principle suggests that companies associated with each other through common control operate as a single economic unit, and therefore they should consolidate their financial statement. A single economic entity, for example, if you have a company, then that company acquires some subsidiaries, or that company have other branches, then that is supposed to operate as a single economic entity. Therefore, they're supposed to consolidate their financial statement. They're supposed to consolidate their financial statement to report as if they operate as a single economic entity. Then we have the next principle, which is the accrual concept, and it requires that income and expenses must be recognized in the accounting period to which they relate rather than on cash basis. For example, we have accrued expense and prepaid expense. Uh, this principle requires that you don't recognize expenses on cash basis. For example, if the rent for this period, for let's say the rent for this period is 100,000. That is the rent for the whole year. Then in that year, you find that you have paid 120,000 as rent. Therefore, it means that you have paid 20,000 extra in rent. That is going to be recognized. The 20 extra that you have paid is prepaid expense and is going to be recognized next in the next year. It is going to be recognized in the next year. Okay, let's give another example to of this accrual concept. For example, you have incurred expenses. Let's say it is insurance expense. Let's say that this year the insurance expense are 100,000, but you pay 90,000. Therefore, it means that there's 10,000 insurance expense that you have not paid for this year, which means that those expense will be paid in the next year. Then you're supposed to recognize for this year, you're supposed to recognize the whole 100,000, which is your insurance expense. Then that 10,000 is going to be, it is still the expense for this year, but you're going to pay it in the next year. So you are going to recognize it as an accrued expense, which you will take to your statement of financial position as a liability, because it's a liability that you're going to pay in the next year. And in the first example where we have discussed about the prepaid expense, the prepaid expense are recognized in the statement of financial position as assets of as current assets of the business. Then we go to the next principle, which is timeliness. And this principle, it requires financial information to be prepared and available to users on time to enhance their decision making. So this principle simply requires the financial information to be prepared and available to the users of that financial information on time. Then we have the principle of comparability. And the principle of comparability says that financial statement of one accounting period must be comparable to another period for users to derive meaningful conclusion about the trends in an entity, financial performance and position over time. Therefore, comparability is simply financial information being, you can be able to compare financial statements of this period and with a previous period. You can be able to compare financial statement of this period with a previous period. And the reason why you can be able to do that is due to this principle of comparability, because you're supposed to use same policies. You're supposed to use same policies to enhance this comparability. And also you can be able to compare financial statement with financial statement of other industries because they are prepared using same standard. Then you go to the other principle, which is the principle of consistency. And this principle says that financial statement must be consistent with other entity in the same line of business to help the users analyze the performance and the position of a company relative to the industry. So consistency is about uh, preparing financial statement using the same accounting policies within the same industry so that the users can be able to derive they can be able to derive meaningful use from those financial statements. Then we go to the next principle, which is the principle of understandability. And this principle simply means that the users of financial statement can understand your they can understand your financial information. So anyone who possesses a reasonable level of knowledge in accounting is able to understand your financial statement. Then we go to the next principle, which is the principle of materiality. And materiality means that information is material if it is omission or misstatement could influence the economic decision of users taken on the basis of such financial statement. Materiality simply means that if you omit that information from the economic phenomenon that's being measured, then the decision that the users of that information is going to take, uh, it is a different decision. It is a different decision from the decision that he could make if you had not omitted that information. Therefore, it means that omission of a certain information from the financial statement completely alters or completely changes your financial statement. It completely changes your financial statement. The next principle is the principle of business entity concept, and this principle maintain that transaction and balances of a business entity are accounted for separately from the owner. So the principle of business entity concept simply means that the owner of a business is separate from the business. Therefore, you have to account the transaction of the business separately from the transaction of the owner. Then we have the next principle, which is the duality principle. And this is the underlying principle of double entry in accounting. That is, for every credit entry, there must be a corresponding debit entry. So the duality principle simply means that each transaction is recorded, each transaction is recorded twice on the credit side and on the debit side. For example, if you have if you have cash, if you have cash and you use that cash to purchase, you use that cash to pay for an expense. For example, let us say it's a rent expense. Then you are going to debit the expense and credit. You're going to debit the expense and credit the cash. Therefore, you have recorded that transaction on the credit side of the cash and on the debit side of the expense that you have paid. Duality principle simply means the double entry concept. Then we go to the next principle, which is revenue recognition principle. And this simply means that revenue is recognized when earned, irrespective of whether cash is received or not. If you make a sale, you recognize revenue, even if that sales was on credit basis, you recognize that you have earned revenue because if the sale was on the credit basis, then it means that the debtor is going to pay you in a future period. Then we go to the final principle, which is the principle of going concern. And it is we say that this principle, it is one of the fundamental assumptions in accounting on the basis of which financial statements are prepared. It assumes that the business entity will continue to operate in the foreseen future without the need or intention on the part of management to liquidate the entity or significantly curtail operation. So if the going concern is invalid, financial statements are prepared on a breakup basis. That is, assets are recognized at amount expected to be received if they are sold, and liabilities are valued at amounts likely to be settled. So therefore, going concern simply means that you're preparing financial statement on the basis that the company will continue to operate in the foreseen future, and the management has no intention to liquidate the company. Usually the going concern when financial statements are prepared is usually for a period of 12 months. When the management or when the directors produce the report of their financial statement, they usually say that the company is going to be operational within the next 12 months without any intention to liquidate the company or to curtail the operations of the company. Then it can happen that uh, the management or the leaders of the company might see that the company has a going concern problem. They might see that the company is not able to cannot be able to operate in the foreseen future, and therefore there are some indications that can indicate there's a going concern problem. There are some indication that when any financial analyst looks at the company, they see that this company is not going to operate, its future is doomed, or its future is doomed. Therefore, we can see in the next objective what are these possible indication of going concern problem. What are these indications of the going concern problem? And the first indication is significant trading losses being incurred for several years. If your company is having a lot of trading losses, each period you are making loss, each period you are making loss, and it has been several years and you're still making loss, then it means that the company is doomed to fail. The company is doomed to go to bankruptcy because of uh, trading losses. Therefore, that is one indication that there's a going concern problem. The next indication is deteriorating liquidity position of a company not backed by sufficient financial arrangement. Liquidity position simply means that the company is not able to settle its current debt or its current liability. If the company has more current liabilities than current assets, then and, th- and those liabilities are not backed by sufficient financing, then it means that your business is going to fail. It means that your business is not, your business might fail at any time, and that is another indication of going concern problem. The other indication is high financial risk arising from increased gearing level, rendering the company vulnerable to delay in payment of interest at loan principal. If the company has high long-term liabilities, if the company has high long-term liabilities in such that the company is not able to pay the interest on loans on time, then that is a problem. That is a problem uh, which indicate that the company might fail in the foreseen future. Then the other indication is the aggressive growth strategy not backed by sufficient finance, which ultimately leads to overtrading. The management might have aggressive growth strategy. They just want to grow. They just want to grow. So they take a lot of they take a lot of uh, goods on credit and they overtrade. That is another problem. Then the other indication is the increased level of short-term borrowing and overdraft not supported by increase in business. The company is having a lot of overdraft, or it is having a lot of short-term borrowings, and you are not seeing where those overdraft are going. You are just seeing the borrowing, but those borrowings are not leading to increase in the trading. They are not leading to increase in the inflow of cash. They are not leading to increase in business. Therefore, then that is an indication that the company might not operate in the foreseen future. The company might go into bankruptcy in the foreseen future, or the company might be liquidated in the foreseen future. Then the other indication is serious litigation faced by a company. If there's a case in the court against the company, and that case is very serious, that there is a complaints against the company, and that case uh, is very serious, it can lead to the failure of the company. It can lead to the failure of the company, because you might find that you find that many cases have led to the failure of companies. If the company loses the case, it will automatically face if the case is very serious. Then the next indication is bankruptcy of major customers of the company. You find that some of your major customers who buys your goods, who buys your good, or to whom you offer your services, they have gone into bankruptcy. Therefore, if they owe the company debt, if they owe the company debt, then it means that your company is in a serious problem of failure. And also, if major customers of your company have gone into bankruptcy, it means that they will not be able to pay for your services anymore, or they will not require your services anymore, or they will not require your products anymore. And that is a serious problem which can lead to your company not to operate in the foreseen future. Then the other indication is the inability of a company to develop a new range of commercially successful product. You see, companies are growing each day and each day. They are developing new products. They are developing new products which have high competition. So if your company does not have the technology to develop new product, or if your company is still using older technologies and there are new technologies, then it means that your company can be overtaken by the other companies, which automatically will lead to the failure of your company, which means that your company is not going to operate in the foreseen future. Then the other indication, the final indication of a going concern problem is inability of a company to maintain liquidity ratio as defined in the loan covenants. So loan covenants are agreement that you have with your lender. So if you are not able to maintain the liquidity ratio as can be defined by their own covenants, then it, then it means that your company might fail, because if you go against a certain loan covenant, then the the reader of that loan, the reader of that loan can take the reader of that loan can take the security which you had given him for you to be given a loan, and that might lead to failure of your business. And finally, we go to the final objective of this lesson. Final objective of this lesson to understand qualities of useful accounting information. And the first quality is relevance. Accounting information should be worthy to help in making financial decisions. And we say that relevant information is information which is prepared on time. It is information which is accurate and is understandable. And if information have those qualities, then it is a useful accounting information, and that can help users in making prediction or in making other decisions which they require to make. Then the next quality of useful accounting information is timeliness. So useful accounting information must be prepared on time and be available to users of the accounting information on time. The next quality of useful accounting information is reliable, and reliability will simply means that accounting information must be verifiable and authentic. Accounting information must be verifiable and authentic. So this means that it must be supported by evidences. So it must be supported by evidence such as sales receipts, bank statement, and invoices. So if the financial statement is supported by receipt, bank statement, and invoice, then it means that that information is verifiable and it is authentic, and uh, that's another quality of useful accounting information. Then the next quality is consistency. For accounting information to be useful, it must be recorded consistently by applying the same accounting treatment to all at all times to the same accounting data. So consistency simply means that every transaction which is means that similar transactions are treated in the similar manner. You're applying the same accounting treatment to all transaction, and so that information is consistent from period to period. And even if you go to other industries, you find that they are applying the same accounting treatment. So you find that that is useful accounting information because of the consistency. Then we finally is comparability, and we say that for accounting information to be useful, it must be comparable to different accounting period to understand trade-off of a business financial performance. So comparability is all about uh, the financial information having having the quality of being comparable from period to period, and with other with other uh, with other companies which are in the same industry, Thank you very much. I'll see you in the next topic.